All right, let's go ahead and get started today. My name is Chin Chun, and I'm with NACB and the Consultants Training Institute. I want to welcome you to the June 16th edition Around the Valuation International Webcast. There is our disclaimer for the show. Before we get started, I want to go over a few housekeeping items. First, to obtain CPE credit for this webcast, you must answer all the poll questions that pop up on your screen during today's webinar. If you have a subscription to the AVW International Webcast, you'll receive your CPE certificates within 7 to 10 business days after today's webcast. If you have any questions during the webcast today, please use the Q&A feature, as those will be directed to the presenter. One thing is we're going to wait until the end of the program to answer those questions for you, but please feel free to add those questions into the Q&A. And we'll get to those at the end of the show. If you have any questions for me or any regarding NACB or any technical questions, you can reach me through the Zoom feature, through the chat feature in Zoom, excuse me. Right, and today we have Wolfgang Nies and Pratik Shah, who are our editors. Andrew Newman and Brian Jones are not with us today, I don't think. Nope, they weren't able to join. So the June lineup today, so we'll start out with some GACV news items, some business value news from around the globe. After that, we do have an exciting presentation from Eric Vega Domínguez and Juan Toro regarding valuation considerations and asset impairment testing, an emergent market perspective. But before we get started with the presentation, again, I want to go over some few housekeeping items. We do have our conference coming up. I want to play a quick video for you. Hopefully it'll work. Let's go here. Oops, wrong one. Means, yep, so we have our conference coming up in September. I hope you can join us. There's a QR code at the bottom of the screen. You can scan that to take you to the webpage, or you can go to www.nacb.com/conferences to get more information about the conference. We hope to see you guys all there. And next, with AVW, we try to go in depth in some of our topics that we discuss in the monthly webcast. So these are 1 to 2 hour long webinars with the topics related to AVW sessions that we discussed during the US version of the AVW show. So, and with that, I'm going to turn the time over to Pratik, who will get us started with the presentation from Eric and Juan today.
Thank you, Chanda. Thank you, everyone. Thank you, Eric and Juan, for taking out time for this interesting topic. Before we get into this, Chanda, can you move to the next slide so that I can introduce Eric and Juan?
Yeah, I forgot. Pratik, my apologies. We don't have the bios there, but I can read the bios real quick for you. So Eric Vega Domínguez has over 10 years of experience in financial advisory and corporate transactions. He has valued companies in the real estate, pharmaceutical, industrial, hotel, and retail sectors, among others. His valuation work has been used in transactions such as acquisitions of real estate projects, investment funds, banks, financing structure, local. Let's see, sorry, that just kind of went over my screen. Where was I? Local and international investors and share restructuring. Additionally, he has performed financial due diligence projects on cross-border M&A transactions. As financial instrument specialist, he has carried out projects related to compliance with IFRS 13, AIS 36, and IFRS 9 related to expected credit loss in loan and investment portfolios of banks and other financial institutions. We also have Juan Toro joining us today, who's the Director of Financial Advisory from Grant Thornton in Panama. Over 13 years of experience in financial statements, audit projects, and accounting advice in accordance to IFRS, ISA, and PCAOB standards for banking economic groups and other entities in the financial and non-financial sectors at a local and regional level. He joined Grant Thornton Panama as Director of Advisory and Valuation in 2022. Previously, he worked for more than 12 years for one of the big four accounting companies in Venezuela and later in Panama, where he held the position of senior manager in the area of financial services. In this last role, he led and developed the unit specialized in financial instruments for banking and insurance entities. Additionally, he has participated in IFRS-related advisory projects, including IFRS 16, IFRS 9, and IFRS 13 implementations, including the preparation of financial models for the valuation of cash generating units and financial instruments, hedge accounting strategies, and accounting advice on complex transactions such as mergers, acquisitions, spin-off, entity dispositions, and share-based payments. And with that, I want to thank Eric and Juan for joining us today. I'm going to turn the time over to them.
Thank you. Thank you, everyone. Okay, ¿le gusta start?
Yeah, we can go ahead and get started.
Yeah, I think Eric is mute.
Hello? Hello, can you hear me?
Okay,
yeah, we can
yeah, yeah. Okay, let's go. Thank you to join us. Today, our presentation is relating to valuation considerations in asset impairment testing and emerging market perspective. This one. Who is the, can you change?
there you go.
Okay, relating to disclaimer, some few disclaimer, all comments made in this section do not represent the position for Grant Thornton. Likewise, the comment on the instrument do not represent any preference and cannot be considered as an advisor. Okay, I would like to start this presentation with why this topic is important and its special relevance. And it's for current climate of economic uncertainty such as tariff, the war of tariff, also a potential event of change in circumstances that could be negatively affect the key assumptions such as climate matter consideration. All of these, they are trigger events that can be impair the financial asset of the company. So this is why very important accounting rule that giving impairment at this time. Our agenda is relating to an introduction of IFRS. Also, we have a key definitions and objective. Then moving to the emerging market challenge. Number 4, practical valuation considerations. Then we have the last 2 points is relating to the case study and our recommendation for the impairment testing. According to the IFRS, on the financial instrument, the asset impairment is a accounting rule below under EA 36 that establish the way that you can estimate the impairment of the financial assets or the group of assets for the reflecting the recovering amount of or in the financial statement. The key definition objective to understand how can we deal with this, we can see in this graphic, because we need to identify the potential impairment that is going to be events, that is external events or internal events inside the company. So the question is the recovering amount less than the current amount? This is the question. If you say no, but no impairment losses, but you say yes, you need to recognize impairment losses. And then we need to reduce the current amount and then have a disclosure in the financial statement. But what is the recovering amount? The recovering amount is the highest of the value use and fair value less cost of disposal. This is very, very important because we have a value use that is a perspective of the entity, specific entity. In another hands, we have the fair value less cost of disposal that is a perspective of the market perspective, is under IFRS 13. So we have two accounting rules that we need to put in place to figure out the recovering amount. Also, we need to say what is the carrying amount. The carrying amount should be a single asset. For example, investment property measurement under the cost model, or a cash generating unit. And this cash generating unit should be a group of assets that has in the independent revenue stream. Independent revenue stream should be a segment of a company, and or a company could be, or they can has different cash generating unit for the valuation. When should an asset or group of assets be testing for impairment? So the accounting rule established annually for intangible assets with indefinite useful life, intangible asset not yet available for use, and others when the cash generating unit has allocated a goodwill or a corporate asset. And in each reporting day, assessment when there is a trigger event that can be impair a group of assets. So what is this is the trigger event. For example, external issues. When the current amount of a net asset of an entity exceeding is the market capitalization. This is at the first time, or you can say, okay, they are a problem with the cash generating unit. When the market capitalization divide the total book value is less than 1 or inclusive negative. Although a significant adverse change in the technological, market, economic, or legal environment in which the entity appears, or in the market to which an asset is dedicated. So we have time regulation, new tariff, general AI can impact external of the matter of the company. Also, an increase in the market interest rate in a period, leading to the material decline the asset recovering amount. On the other hand, internal uses should be a damage, physical harm in a company, also change to the useful life, and others should be reorganization, change the company matters. So this kind of there could be events, internal and external events that can impact the impairment, the asset of the company. The triggering event from the diversity company from 2020 until now should be we found oil price collapse, business adjustment, clients losses, country risk increase, strategy shift, reorganizations, stock price decline. All of this gonna be a trigger for impairment the asset or group of assets. Relating to the corporate asset, normally the corporate asset is allocated to the old cash generating unit as a proportional. And the goodwill can appears when the price exceeding the fair value in a transaction, the business combination. This is appear the goodwill. This is a focus or the possible impairment when you have a higher goodwill in a company allocating in one cash generating unit. So be careful with this. We need to mandatory have the impairment test annually. This is a brief example. Company C business comprise 3 cash generating units, X, Y, and Z. Cash generating unit X and Y are profitable. However, a downturn in the market for the product sold by cash generating unit C has resulted in operating losses for the cash generating unit, which management conclude is an indication of possible impairment. The question is, should cash generating unit X and Y be tested for impairment? Of course, that C tests cash generating C for impairment because they have an event, a trigger event. But for the cash generating Y and X and Y, if don't have any corporate asset or allocated goodwill, you don't need to do anything, but otherwise you need to testing for the impairment test. Related to the emerging market challenge, by the way, this is a challenge for the valuation in general, but more deep in emerging market, we have market volatility, uncertainty in cash flow, currency, and political risk, high inflation, limited peers data, high cost of capital. This all is mainly issues that we need to face for the impairment test and the evaluation of the cash generating unit. This is the out of scope because IFRS established that these all assets are out of scope of the IFRS: inventory, deferred tax assets, financial asset, biological asset, insurance asset, contract assets, employee benefits, investment property, when property measurement of fair value, no current asset. So normally the cash generating unit is a current asset less current liability plus PPE, properly plant and equipment plus goodwill. Normally this is a cash generating unit that you need to apply a testing for develop or for figure out the recovering amount of this asset. Okay, Eric, you can start.
Yes, thank you, Juan, and thank you to the whole Around the Valuation World International. In this section, we're gonna see some concepts related to practical valuation considerations, some concepts that later on in the next section, we're gonna see how they play in a case study. So let's see this section. I want to focus or highlight the differences between fair value and value in use. These two concepts are important to identify because both of them generate the picture of a recoverable amount. Well, the first element, I would say that IFRS 13 is the standard that we are gonna refer to when working on the fair value measurement, and IAS 36 is the one that we're gonna use as a guidance for value in use. Both of them work on single assets, cash generating units, and group of cash generating units. Related to the definition of value based on each standard, for fair value, IFRS 13 mentions that the fair value is the price that would be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants. As Juan mentioned, the focus of IFRS 13 is market participants. On the other hand, value in use under IAS 36 is the present value of future cash flow expected to be derived from the asset or cash generating units. Once again, the focus is on the value generated from the use of assets, is inside out. So this is some differences. Interestingly, there are 4 concepts that we have to exclude of the valuation of fair value under IFRS 13. Those elements are excluded, mainly asset grouping value, entity-specific synergies, legal rights, restrictions, and tax benefits. Those elements are, as you can see, are more company-specific, so it is not taken into consideration in fair value. However, in the value in use under IFRS, under IAS 36, it is included because it's more company-specific. We have grouping of assets, entity-specific synergies, legal rights, and tax benefits. All are included in the calculation of value in use for the recoverable amount. Regarding an important difference between the scope of fair value and value in use is the usage of approaches on valuation. Fair value under IFRS 13 guide us through the use of selection of criteria to select a market approach, income approach, and cost approach. On the other hand, value in use under IAS 36 focuses on a present value technique, which is an income approach with its specific specifications. However, is mainly focused on income approach. That's differences between these 2 values. Cash flow premises under IFRS 13, fair value, the cash flow premises is exit price, principal market, highest and best use, and IAS 36, as we have seen, it focuses on current use of the asset or cash generating units. Differences related to cash flow starting point. Both starting point is the entity-specific budgeting and forecast. However, fair value considers adjustments for market consideration. And IAS 36, these differences need to be justified for a inside-out perspective from the company. Differences when we talk about forecast period guidelines. IFRS 13 fair value is focused on reflecting assumptions that market participants would use, while the forecast period of IAS 36 is maximum 5 years plus unless a longer period is justified, and cash flow projections after the forecast period are extrapolated with a terminal value and growth rate. All these concepts, we're gonna see how they play in the case study a little bit later. For example, looking at the cash flow assumptions, elements such as capital expenditure, restructuring, and corporate overheads, how they play with each type of standard. IFRS 13 fair value includes the 3 of them if, this is the important part, if it is consistent with market participants' perspective. and IAS 36 exclude future expectation of capital expenditure, restructuring, and regarding corporate overheads, it allocates the cash generating units with exceptions. And regarding the discount rate, the differences between both standards, for example, IAS 36, IFRS 13 rate reflects assumptions that market participants, and IAS 36, the rate reflects the current market assessment of time value of money and risk. As you can see so far, the difference of perspective combine or go down to the each concept from both perspective, from the market participants and the use of the assets. Here is a quick reminder of market approach. I'm gonna go fast on these slides because is our concepts very well discussed in this type of area. However, highlighting some concept, for example, that business valuation analysts use the market approach by identifying and analyzing sales of similar businesses. This is the public or private, or by using the stock price of similar publicly traded companies and applying their valuation multiples to the subject company. That is a market approach. When talking about market approach, as we mentioned, and also Juan, we refer to the IFRS 13. Here is a roadmap of the steps of applying a market approach based on IFRS 13 guidelines. When talking about the usage of mergers and acquisition method, which is more related to transactions, there are pros and cons. In emerging markets, for all the concepts, there are interesting challenges to face. In this area, for example, the availability of information is important to be sure if we have the information useful for the valuation practice. For example, related to the discounted cash flow, there are ideas around the development of scenarios of discounted cash flows that are having interesting developments, because creating scenarios of discounted cash flow give us the visualization of different alternatives, and we can enrich the analysis, either a traditional valuation for transaction, and also in this testing of impairment of an asset or cash generating units. It could also help us to derive information that for emerging markets also are quite difficult to get information to related to the discount rate on the market. We're gonna see a little bit how it plays on the case study. Something that is excluded, synergies, of course, revenue synergies, cost synergies, and financial synergies are excluded of the income approach. And there is a concept, the concept of cost of disposal, that is deducted from the value, from the fair value under the concept of fair value less cost of disposal. The standard identifies 3 lines that could guide us to find information that are more practical, more more like rule of thumb, legal cost, transaction taxes, and preparation costs. In practice, we have seen these discounts between 5 and 15%, depending on the market, depending on the company. But anyway, these lines are very helpful to identify the discount. And when looking at the fair value less cost of disposal under the cost approach, of course, we use the concept of depreciated replacement cost, which includes physical obsolescence, functional obsolescence, and economic obsolescence. In this case, we're not, well, in the case study, we're not using this one, but we wanted to present all the options. And in the concept of value in use, of course, EAS 36 guide us to use concepts to build a present value of the economic benefits of the current use of the asset by applying or taking into consideration future cash flow, the variation of those cash flows, of course, the time value of money, the price of uncertainty, and other elements such as illiquidity, and that would be reflected. When talking about the discount rate for value in use, the standard guide us to have mainly three blocks. However, inside each one, there is a lot to work on, but mainly risk-free rate, risk premium, and uncertainty, what we call alpha, this element that comprise all the risk related to the cash flow that need to be showed or reflected in the traditional discount rate. So let's see how it plays, how those concepts play in a case study, so that we can illustrate what the standards guide us to work on. Let's consider a goodwill impairment test of a construction equipment company. Let's say that the cash generating units have a carrying amount as defined by the standard, of course, and mentioned by Juan Toro a couple of minutes ago. The carrying amount, the book value, the carrying amount of the cash generating units, let's say it is 68 million. Now we have to compare this amount to the recoverable amount. And to define the recoverable amount, we do two valuation or two approaches: the fair value less cost of disposal and value in use. We practice both of them, and to see the highest between those two. We're going to start looking at value in use. As we mentioned, there are two approaches for value in use. The first one, well, the main difference is that where the model identify or reflects the risk. In traditional approach, the risk is incorporated in the discount rate, and in the expected cash flow approach, the risk is mainly reflected in the cash flow using expectations and probability. So that's important. Let's divide the analysis of the value in use into forecast period and discount rate. Let's start with forecast period. In the forecast period, in a traditional way, we start by the budget prepared by the management and create a forecast of maximum 5 years based on the information that the management organized. However, it is mainly the best expectation of the company, only one line of cash flow, future cash flows, and the discount rate, the standard defined as the rate commensurate with risk, where we incorporate all the risk. Let's see first the forecast periods. Here we have an example. We have an illustration of a forecast period of 5 years. Here we can see the total revenue, how it goes according to the management team. Let's say the management give us this information. It expects that the cumulative annual growth rate of the next 5 years was going to be 5.53 of the total revenue, and so we have the cost of goods sold and administration expenses, and so we can look at net income that is coming from 8.6 million to 11.8 million. So this is the first model, let's say, that we received from the management, and we are going to work on it. The standard guide us to start with the approved budgets or forecast, and highlight that we have to consider to exclude elements such as restructuring and financing activities, the effect of financial activities, to reflect the current use of the asset, of the cash generating units. Also, it tells us to take into consideration elements that need to be in the model, for example, day-to-day service and cash flows to maintain the level of economic benefits, to include the extrapolation of an appropriate growth rate and the incorporation of disposal proceeds. So in the next slides, we're going to see all of this very quick to see how they play in our case study. Restructuring, this is important and a difference between the model built by the management, because to reflect the value in use, we cannot include elements like restructuring, like planned restructuring, only if it has been already committed, if it is already on the way, if it's already materialized in some way. That is the only alternative to include on the model. However, if it's only a future plan of restructuring, we cannot include in the value in use valuation. For example, here is an element related to our case study. For example, let's say the management approved a budget that reflects two elements: estimated cash flow necessary to maintain the level of economic benefits expected to arise from the asset in its current condition. This is A. And B, that in 2026, the management plans to incur in 5 million to enhance the asset. Which one we should include? Well, of course, only the element A, because B is a planned restructuring. So let's see how it works. For example, here in the left side, we identify where, for example, CapEx is the management recognized the planning of 5 million extra and the incorporation of sales, extra sales as a reaction of this restructuring. That is an expectation. We cannot include it, and so in the right side we can see how we normalize the forecast. Elements to be considered are that the financial activities, because the value in use is independent of the financing decision. For example, when we build the free cash flow to firm, we start by the earnings before interest and tax, plus the marginal tax rate, depreciation, capex, and working capital, without including interest. That's the element highlighted by the standard. And also, when building the discount rate, the capital structure, when calculating WACC, it should be also based on not on the current condition of the company, but a market or a target capital structure. We need to include day-to-day services. For example, it means mainly that we have to make sure if within the cash generating units there are assets that need to be replaced. The model of replacement along the way on the forecast period need to be modeled so that the business is maintained in a standard and a current way. That is what this element highlights. The extrapolation of the period it refers to the growth rate. Of course, the standard highlights that the growth rate needs to be a steady or declining rate, even a rate of 0 or negative rate might be also appropriate. So at the end is the messages that we have to be very careful regarding the growth rate, because it has a huge impact on the valuation. And of course, the incorporation of disposal proceeds, it depends, it relates only when we are valuing the value in use of an asset. But if we have a cash generating unit that is a business, an ongoing business of a group of assets with no specific useful life, it's not considered, but it's important to have it on the table. Regarding the discount rate, at the end, well, the important element is we can start with a WACC plus considering extra element like country, current, currency risk, country risk, company specific risk. This chapter, let's say, is very challenging for emerging markets, and because the whole literature and practice is based on developed countries, and the translation of emerging market risks is very challenging. In countries like Panama, for example, the risk-free rate is based on US dollar, because we use US dollar as well. It means that our valuation based and our risk-free rate is also needs also be considered based on the same currency. And in practice, we use bonds, corporate bonds with risk-free rate based on the US from 10 to 20 years. Lately, a debate has been arised by the the fact that Moody's also downgraded the bonds, but this is a huge topic to talk about maybe in another section. Well, alpha factors, where we find or try to incorporate all the risk of the cash flow that are not incorporated in the CAPM, in the normal CAPM modeling. Might consider size risk, country risk, company-specific risks like forecast, illiquidity, etc. Is a great topic of debate. However, from our point of view, in our normal practice, in audit, a very important factor is the argument, the page where the argument is exposed, to where to if adding or not a particular factor or particular risk. That's the most important, because the valuer that has studied the cash flow needs to understand its risk and justify the usage of one or another extra risk factor into the model. In this section, for example, here we see the risk-free rate, levered beta, that we incorporate with a markets participant capital structure to leverage the beta. Equity risk premium to make a capital asset pricing model standard plus alpha factors. Here we add country risk premium. You may say, why we don't add a size premium or company specific? Just to illustrate that there are arguments, arguments to justify this. That's the important thing. Might be that the cash flow is in the cash flow already. We incorporate the model or the risk of being a small company, or we incorporate all the other risk. In this way, we finish the value in use with a total equity of 87.9 million after having the forecast period, the calculation of free cash flow, the terminal value, adding 2% of long-term growth rate, and netting it from the net debt. We have a value in use equity value of the cash generating unit of 87.9. This is one element, and the other is fair value less cost of disposal, which is, I'm gonna be very quick in this section, which is based on a market approach. We identify the 7 comparable companies. We select the multiple of enterprise value and to revenue, adding a DLOM, discount for lack of marketability of 26 based on some studies, some different studies that document around DLOM. And at the end, we deduct the cost of disposal to arrive at a fair value less cost of disposal of 71.7. Those are some ways to calculate the DLOM and the cost of disposal. But in summary, as you have seen, we have built the value in use, and we have built fair value less cost of disposal. Here we have both of them, 87.9 for value in use and 71.7 million for fair value less cost of disposal. The recoverable amount is defined by the highest, which means that value in use defines the recoverable amount. Now, this recoverable amount is compared to the carrying amount of 68 million, which tell us that there is an excess on value of 19 million, 20 millions. In this impairment test, there is no impairment signals for the cash generating units. However, in case of that the carrying amount is higher than the recoverable amount, then we would recognize impairment of the cash generating units. This is a very summarized way to go through to an impairment test under IAS 36. So I hope it was clear enough. Some recommendations, final recommendations, assess if new issues result in an indicator of impairment, for example, impact on sales, increase production cost, impact investment or business plan, impact companies' market capitalization, in valuation practice. In some cases, climate-related matters may be also reflected both in the cash flow and discount rate. This is something that is having a new thing that is having a place on the talk of valuators. The climate matters. Also consider building models related to expected cash flow approaches, which is more focused on the cash flow to incorporate risks. It could add value to the models. And finally, I would say that based on emerging markets challenges that we have seen and mentioned in this presentation, there are some ideas that might help in future considerations. For example, last year in April, I joined actually friend of mine and friend of the European Association of Certified Valuators Analysts, Professor Dietmar Ernst and Bernard Gleisner. We wrote in Harvard Deusto Business Review, the magazine, an article related to simulation-based business valuation, which is connected with their writings, and it might also the model of creating free cash flows and discount rate based on the risk inside the company could add some interesting ideas for emerging markets while building impairment tests from the expected cash flow approach, and also to identify the level of risk, implicit risk into the company. Just to mention, have a look for the Spanish speakers, for example, this is in Spanish, and they have also papers in English. So having said that, we have reached the end of the presentation. If you have any question, you are very welcome.
Great. Thank you, Juan. Thank you, Eric. Great presentation today. Let me just check one more time. There was one question that came in, but I see that Juan responded to it through the Q&A. It may be beneficial to respond to that verbally too, so that anybody who watches the recording may have the same question. The question is, how do you develop CSRP or market adjustment to multiple? I see that Juan responded to that. If you want to just kind of summarize what you said, Juan, that would be great.
Yes, sir. you need to use peers to try to develop an adjustment of the projects, of the cash flow projections. Normally, you use a objective to allocate to reduce just a little bit the cash flow for the uncertainty of the cash flow estimation.
Great, thank you so much, Juan. I know you typed that, but I was like, just in case somebody else has that same question later. So, all right. And let's just see if anybody else has any questions. I don't see any that came in, but if you have a question, please feel free to type that in real quick. Again, we do thank you, Eric and Juan, for joining us today. Let me
No, thanks to
go
you.
ahead and place.
Thank you very much.
Yeah. So our next AVW International Webcast is scheduled for July 28th, 2025. We look forward to having you attend that session as well. And we want to thank you for joining us all today. Let me just do one more check to see if there's any questions that came in. I don't see any. Yep. Let's see. All right, Eric and Juan, I don't see any other questions, so I think we are good to go. Thanks again. That was a great presentation. Look forward to hopefully working with you in the future too. All right.
Thank you.
Thank you all for
Thank
joining us
you.
today.
Thank you
Thank
to
you,
all.
Eric.